Hey, everybody. Hopefully you're killing it in the markets. Hopefully you're having a good time doing it too. My name's Andy. My channel's Finding Value. If you like making lots of money or if you need help making more money, this channel's for you. So subscribe. Give me a thumbs up for this content. I'm going to talk about inflation and interest rates. And these are drivers of money rotation. And I think it's very advantageous to understand this inside and out. And I'm going to give you my opinion on inflation and interest rates. So let's jump in here and talk about inflation and interest rates in this presentation. So understanding these dynamics. So inflation comes first. That's what spurs this change. Interest rates chase inflation higher. This puts in motion a rotation of money from sector to sector because that interest rate changes things. It changes the risk-free rate of return on bonds. It changes the willingness for people to buy stocks, which is considered risk on. I'm sure you've heard that term before. And typically what people do, if inflation is big enough, they're going to start going to what they call inflation hedges, like precious metals and commodities. So really, the rotation or flow of money prices assets differently under these market conditions, those three that I just talked about above. Inflation and interest rates are the drivers, and then that puts into motion that rotation of money. This is probably the most important thing to understand as an investor. And ratios tell us where the money has flowed already and where it's flowed out of, because the ratio would be cheap in relationship from asset to asset, priced against history. We can tell what's cheap in relationship to history. So I'm going to get into a chart here. It's inflation is the biggest driver of interest rates. And this is a copyright of Casey Research. You can see the 3-month Treasury bill in the blue, the CPI annual change in the red, time on the bottom, interest rate on the left. I should say y-axis interest rate, x-axis is time. And you can see that inflation typically, granted we lost some data here. Inflation typically, this is CPI annual change. I don't really even consider that inflation, but typically it's a leader. And sometimes you can see that some of them get in motion, but usually it leads first before the Treasury bill, typically. It looks like back here that almost the 3-month Treasury bill was anticipating inflation first. But if you look on the backside here, you can really tell inflation starts to drop and then the Treasury bill drops, basically. And then you'd see this move up higher, then this would chase. This would move up, and then this would lag. Typically, that's how it typically works. So I'm going to go to another one. This is the housing starts. This is the driver of inflation. And whenever you go into a expansionary phase, that's 1,500,000 units. That's 1.5 million. You draw a line across here. Whenever it goes above that line in an expansionary phase of real estate, that's where it becomes very inflationary. And you can tell, I can take an example here. This is a leading indication. This went up. It was right about 1970 that the housing starts started to increase, and we went into an expansionary phase right after 1970. And I'm going to show you in the next chart what that looks like. So we've got 1970. 1970 is right about here, and you can see that the M2 money supply shortly thereafter started increasing, right after 1970. That is the housing starts increasing at 1970. That's the housing starts going up. So the M2 money supply goes up when this goes up. Goes up, goes up. Inflation in the red. So this is the M2 money supply in the black. The red is inflation. So the housing starts correlate with the M2 money supply, and then you'll see an offset delay of inflation a year or two after. And inflation correlates with commodities and precious metals. So the yearly growth versus inflation, this is important to understand. You can tell that back here, it gets all jacked up because they start printing money and trying to stop this natural cycle. So this was the natural cycle without, we'll call it a unaided, unmoney printing era back here, where you can see the M2 money supply go up and down based off of demographics and real estate. Over here, they start printing a bunch of money and it gets all jacked up. Like we were having a crash, so they printed some money in 2001, and that's why this goes down while this goes up. Same with 2009, the crash in 0809, they printed a bunch of money to try to offset this. So then some of this gets all jacked up. it disconnects itself. But typically what happens is the M2 money supply goes up before the inflation rate. So things are getting all jacked up. They're starting to print a whole bunch of money. Obviously, there's a deflationary force under some of this that they're trying to combat or fight. There is some of that going on. So I'm not 100%, it's all inflation. There are forces that they are fighting. So some of these guys that say there's deflation, they are fighting deflation, but they're winning. That's kind of what I'm getting at. This is the commodity index to S&P 500 ratio. Whenever the ratio is below, I'd say whenever it's below 2, it's very cheap for commodities. And whenever it's above 7, it's very expensive for commodities. These are our buy and sell signals. And it also tells you that money has flowed out of commodities when they're at the bottom. Money's flowed into the commodities when they're at its top. And that's what the ratio is telling us, is it's saying that commodities that this money has drawn, so the money that goes into commodities has drawn it from the S&P 500 ratio or stocks. And when it goes up, it's drawing money into the sector of commodities. And when it goes down, like here, it's drawing money out of commodities and into the S&P 500 ratio, 500 when it comes down. So right now, what we're saying is commodities does not have the money flows in it right now. All the money's in stocks. And we want to be invested in commodities right here because of the money flows that have been not going to commodities, but have been going into stocks. Eventually, that money is going to flow out of stocks and into commodities coming up very soon, in my opinion. So this is the 100 years of commodity valuation. This is commodities versus the Dow Jones over 100 years. And right now we're at 0.006. I'm going to show you what that looks like. 0.006 right here, breaking out of this big downtrend of commodity to Dow ratio. It's breaking out that it put in a bottom is breaking out of the downtrend. So we are at 0.006. We're like down here. We're like not even showing up on the chart here. That is how radically undervalued commodities are right now, is at 0.006. And we are just peeking out of this bottom. What this means is that we have never seen an opportunity this large in anyone's lifetime that's lived ever in terms of commodities being this cheap to stocks. They have blown up the stock market that much with low interest rates, and the money has been drawn so much out of commodities that when this rotation happens, we will probably see massive inflation, and we're probably going to see a large money rotate out of stocks and into commodities eventually. So here we go. This is a Dow to gold ratio. Gold is kind of a proxy of commodities to some extent. And I just want to show you that this was before the Federal Reserve Bank. It was pretty steady coming on up, meaning that stocks were outperforming gold for the majority of the time. That means that businesses were growing up at a faster rate than gold, and that gold was our money at that point too. So it was a little bit different with gold being at a fixed rate of, I think it was $20 an ounce or $25 an ounce way back here. And then it went to $35 an ounce, and it changed and changed and changed. But going forward, we've got this massive, out of control, completely screwed up fiat capital era in 1913 and on. And this is going all over the place with the Federal Reserve. And I think this is going to head way back down to potentially even 1, maybe even 0.5. Maybe it comes and blows out the bottom here. And all that means is that gold's going to outperform stocks. And looking at the commodity ratio over here, it's definitely going to have to happen because the money's flowed out and it's going to come back and rotate back into it. So changing market conditions. I think changing market conditions will drastically change the flow of money coming up because of real estate. And I think interest rates are going to go higher because of the inflation from real estate. I think it will flow out of bonds and stocks into commodities. The money flows. Valuations tell us that commodities have never been this cheap in history. Ratios tell us that commodities are cheap to whatever other asset you want to measure them by. They are cheap. And what I propose is that you subscribe to the channel to see what sectors and companies I like for this once-in-a-lifetime opportunity in commodities. And join our community. I do think that we're building a community here. Ride this commodity bull up with me together. Let's ride it. Let's ride this bull market together. That's what I'm going to say here. And I want you guys need to understand interest rates, inflation, market conditions. the ratios and how the values are. And I know some people in the comment section, they're saying, well, how do you know this is cheap? It looks like it's gone up a lot. This is nothing. This is absolutely nothing. This is like the first little kind of just coming out, breaking out of the gigantic downtrend for commodities. And I think this is going to be a very big commodity boom coming up. So my opinion has been identify the cheap sectors, buy some companies in all of those sectors, spread the money out. And depending on how risky you want to get, it's not my money. I'm just giving you financial education. This is not advice. What I'm doing is spreading my money out amongst a bunch of different small caps, which are very risky, and using a investing strategy to reduce risk, which is limiting my portfolio allocation to each of these small cap companies of only a few percent of the entire portfolio. It may only be 1 or 2%, and I might overweight up to 3 or 5%, depending on the company and how much I like the company and the potential rewards and valuations at that time of that company. So that's been my take on it. If you guys need help doing this in financial education, check out my other videos, subscribe to the channel. I go over a lot of this stuff. I go over market conditions and how they're changing and the valuations and how those valuations are changing over time. The changing of the ratios also tell us how money is flowing from one sector to another. We can tell when platinum's outperforming gold that commodities are favorable, and that when copper is outperforming gold, they tell us things. They tell us signals. They are signaling saying commodities are game on. If you want information like that, subscribe to the channel. Give me a thumbs up for this content. Leave comments below if you guys don't understand this content. I can always do other videos. I want the channel here is established to help you better understand the financial markets. That is my goal. And when I'm successful at doing that, you should see your accounts go up in value over time. If you like this content, give me the thumbs up. And thank you for listening. This is Finding Value.